Okay, folks, welcome back. Hope you had a good break. Couple of things. One is, I hope you picked a company to value. If you haven't yet, you will get a prompt from me because I'm going to go through the master sheet. And if I don't see a company name next to your name, I'll just send you an email. I'm not trying to be obnoxious. I just need to make sure that you're actually still thinking about picking a company. You picked one, didn't enter it in there. The second is I will offer that one-time deal if you can turn in your discounted cash flow valuation by next Friday. I will take a look at it, not grade it, at least tell you, maybe you want to tweak this number, or maybe I'll just say this looks good. You can move on. And it's just a spreadsheet, the actual valuation. So in fact, after I'm done today, I'll send you the directions on how you send your spreadsheet to me, because I'll be very specific about what subject to put. And it's not because I'm picky, it's because it goes into a mailbox with all these. So I need it to be in one place to be able to find them. And I'll try to get them back to you as soon as I can. And finally, if you want to use my spreadsheet, I mean, by all means do so. This is not an Excel class. So I'm not measuring on how well you can build spreadsheets. I'm not even sure that's a great skill to have anymore. To be quite honest, other people can do it for you. There are people far better at Excel than you or I. So this is a class where I want you to focus on the valuation part. So feel no shame if you use my spreadsheet, because I'm not valuing the company. You're still valuing the company. All I'm doing is providing you with the architecture to be able to value the company without building from scratch. So today I want to talk about a couple of things. One is I want to finish off with the loose ends that I haven't talked about yet. How to deal with complex companies. Some of you are valuing complex companies. What to do about debt when you get to the firm value. What to do about debt. And finally, stock-based compensation, a hugely misunderstood aspect of valuation, and I think a very mangled part of valuation, a lot of valuations. So today's start of the class test, I'm going to focus on the debt and the stock-based compensation part. Let's start at the debt part, right? You take free cash flows of the firm, you discount them back at the cost of capital, you come up with the value of the operating assets. Let's say the value you come up with is 100 million for the operating assets. This company has debt outstanding. The book value of the debt, the stated value of the debt is also 100 million, but the market value of the debt is only 80 million. So here's my question. It's a very simple question. You come up with a value for the firm of 100 million. The debt outstanding is either 100 or 80, depending on whether you use book value or market value. So I'm going to make you pick. If you're doing a discounted cash flow valuation, should you be subtracting the book? We know the rules. When you do cost of capital, it's always market value, right? The weight should be market value weights. But this is a different question. You value the firm. Should you be subtracting out book value or market value? Because you subtract market value, you get 20 million is the value of your equity. If you subtract book value, the company's equity is worth nothing. This is, I think, one of the messiest questions in valuation. I keep thinking I have the answer, but then it keeps shifting on me. I'll tell you what every valuation textbook, including mine, will tell you to do. It says subtract out market value. Because when you do market value of debt, what you do is you take the promised payments. You're acting like you're making the interest and the principal payments, but you discount them back at a higher rate because there's a greater chance of default. So the rule is use market value. But here's why I'm a little uncomfortable with that answer. Let's assume I acquire this company. I'm a nice, safe company. I go out and acquire the equity in this company. The minute I do the acquisition, you know what's going to happen to the market value of the debt, right? Because now it's going to become my debt. Remember, the reason market value of debt is lower than the book value is because you're worried about that lender defaulting. But if I take it over, that potentially could disappear and your 80 million could become 100 million. Yeah. You had a question? No. Yeah. So the reason it's not an easy answer is you can very quickly give, what if this happens? So I'll give you the rule I follow. If I'm doing a discounted cash flow valuation of a going concern, there's no acquisition on the horizon, no liquidation being considered, I stick with market value of debt, even though it makes me uncomfortable. But if you ask me how much should I pay in an acquisition, or what will the equity be worth in a liquidation, then I'm going to go back to book value of debt, because that is what the debt will be due the minute I take away that distress fear out of the process. So it's almost like it depends on the context in which you're doing the valuation, the company you're looking at. Let's take a second example. Let's assume you're valuing a tech company. You've taken free cash flow from discount, free cash flow to equity, discount the cost of equity, you come up with the value of equity of 100 million. There are, I'm sorry, of $1 billion. There are 100 million shares outstanding. Let's start easy. You have $1 billion in equity, 100 million shares outstanding. The value per share is obviously $10 per share, right? And let's say, oh, by the way, this company is planning to grant 10 million options to its CEO with a strike price of $10. You see why I picked the strike price at 10? So I'm basically issuing options that are at the money options. The value per share before I made this grant was $10 per share. How do you think this grant is going to affect your value per share? Is it going to leave it unchanged because it's an at the money option, therefore there's no exercise value? Will it decrease it? And if so, how should we go about estimating how much it decreases it? Or could it in some weird way increase your value per share? What do you think? Until 2007, what did accountants tell us about options, the value of options? They valued options at exercise value. So they basically told companies, if you issue options that are at the money, they're worthless. It's one of the stupidest pieces of advice you could think of, because guess what companies did? They said, nothing times $1 million is nothing. Nothing times 10 million is nothing. They basically gave away entire chunks of companies, and accountants let them get away with it because they were treating options at exercise value. Let's face it, when you grant an option at exercise value, I mean, let's make it simpler. You go to the, you check out the options trades on the CBOE, find an at the money option. Find me an at the money option with 2 months left to expiration or even 2 weeks left to expiration that's trading at zero. If it's an at the money option, there's always a time premium, right? Options have value that exceeds the exercise value. So one of the things we're going to examine today is when you have options outstanding, we can't just take the exercise value and take it out of the process. We have to think about the value of options, which means there's no way around the fact that you have to use option pricing models. Even if you don't like them, you think they're convoluted. This is the one place in finance you have no choice but to use option pricing models. So we're going to talk about debt. We're going to talk about complex companies, and we're going to talk about stock-based compensation. But let's start this process by talking about complex companies. Are any of you valuing companies that are really pissing you off? You know what I mean by pissing you off? The company is it's opaque. It doesn't tell you what it needs to tell you. You read page after page. It's very confusing. Let's face it, not all companies are equally easy or equally difficult to value. So I'm going to start with an experiment. I'm going to come to you with 2 companies, and I want you to think like an investor. Don't think like an analyst or somebody digging deeper. Think purely like an investor. The 2 companies have exactly the same numbers, same cash flow, same return on capital, same growth rate. So in terms of numbers, they look exactly identical. But here's where they're different. Company one, company A, is in a single business. Company B is in multiple businesses. Company A is a very simple holding structure. They tell you exactly what they own, and you can see it. Company B has all kinds of special purpose entities, joint venture holdings. Company A has transparent accounting. What does that mean? You read the accounting and it tells you how much the company made last year, what they own and what they owe. Company B has opaque accounting. What does opaque accounting look like? This is the company where you pick up the annual report. It claims to be written in English. You read it and you have absolutely no idea what they're telling you. You read it again, you get even more confused. See the choice here? 2 companies look exactly identical. One is a simple company, the other is a complex company. So they said, think like an investor. Which of these 2 companies would you price? The simple company or the complex company? Go with your gut. No, I'd say simple company too, right? But here's the problem. if you take my book and look for every if you plug numbers into any of my models, with the numbers being exactly identical, you're going to get the same values. There's nothing in conventional valuation that brings in complexity. You know why? Because we make a very dangerous assumption. We make the assumption that what you don't know can't hurt you. Let me repeat that again. What you don't know can't hurt you because it gets averaged out. You take 100 companies and you don't know much about the companies. The assumption is that things you don't know, sometimes it'll be good news, sometimes it'll be bad news. You know why it doesn't work in this context? What do companies hold back? Good news or bad news? I mean, when was the last time you woke up to an accounting scandal where the company said, you know what, guys? We made 5 times more money than you thought we did. When you get a surprise from companies, it's almost always a negative surprise. Have you noticed this? In other words, there are lots of things you don't know about the complex company, but they're more likely to be bad news than good news, which means that if you ignore complexity, it's going to come back to bite you. I'll tell you when I became aware of this issue. It's late 90s, a company called Tyco had an accounting scandal. For those of you who don't remember Tyco was a conglomerate that grew through acquisitions. It's a very successful company for much of the 90s. Until one day they announced it had some significant accounting problems, like forgetting to tell you there was a $3 billion capex. I don't know how it slipped their minds. And the stock price for Tyco dropped by 80%. But that wasn't the story. The story was on the same day, GE lost 15% of its value. You're saying, why would Tyco bring down GE? How did I describe Tyco? A conglomerate that grew through acquisitions. And what they'd done is they'd use the acquisition process to hide a lot of bad stuff. Because when you do acquisitions, there's a lot of noise in the process, goodwill and acquisition related, and they'd use that to hide a lot of bad stuff. You see why GE was being punished? It was a conglomerate that had grown through acquisitions, and investors were saying, how do we know that GE is not pulling the same bad stuff? I remember a student who worked at GE said, this is so unfair. Why not Tyco? And I said, but what else can investors do? Because once you've been burned, you start changing your pricing for all companies that look like it. And in fact, I was teaching this class that semester, and the week after the Tyco fiasco, GE dropping, I raised the question. Right? In traditional valuation, we've never brought in this issue of complexity into valuation. Should we be bringing that in? Because looking at Tyco and GE, it seems to matter in markets. And everybody agreed that we should. I said, okay. Then our task is laid out. If you want to bring complexity into valuation, there are 2 things we need to do. First, we need to measure complexity. We can't just say we'll know it when we see it. And second, we need to convert those measures into something in valuation, cash flows or growth or risk. Everybody agreed, great idea. So I said, how should we measure complexity? And they said, you're teaching the class, you come up with a measure. And I did, and they didn't like it. Came back the following session, I said, what do you think of this measure of complexity? And here's what I did. I counted the number of pages in the 10Q and the 10K. Incredibly unsophisticated, right? And they said, we're not paying $150,000 for an MBA. It was cheaper then to count pages in a 10K. But my point is, if you look at just the number of pages, I can already tell you which of these companies I least want to value. And you could probably tell me as well. Which of the 10, I have 10 companies here. Which of these 10 companies would you least like to value? Take a look at Citigroup. 1,026 pages in their 10K. This isn't War and Peace. This is how many pages it took them to tell me what happened in 1 year. If it takes you 1,000 pages to tell me what happened in a year, you're one heck of a messed up company. As I said, though, they didn't like it. They said it was too simplistic. I said, okay, what was I thinking? I'll be back next week. And I came back with what I call my valuation shit list. I gave it a different name. But these are all the things that piss me off when I value companies and how much it's a completely subjective score. But basically, I'll give you examples of things that bug me when I value companies. And some of you might have companies that do the same thing. A company that claims to be geographically diversified, but doesn't tell you where. A company that claims to be geographically diversified breaks down its revenues, but you can't recognize any of the parts of the world that they're, it's like, is this a Lord of the Rings universe? I mean, I've never seen, I still remember the first time I valued BMW. They broke down the revenues in Australia, North America, South America, Europe. In fact, many European companies at EMEA, they put in the Middle East and Africa with Europe, don't ask me why, and Oceania. Where is Oceania? I remember, I thought back to my geography classes. Is it lost continent of Atlantis or something? You know what Oceania was, right? I called the investment relations office of BMW. It was Australia, New Zealand, and Indonesia. What do you share in common? They buy an ocean, I guess. But you can see when you do valuation, bundling those makes it really difficult. It's exactly why I don't like the EMEA consolidation. You put in Africa with Europe, what kind of risk premium do I give you? Company whose tax rate goes from 30% to minus 15% to 55%. Some of you are valuing companies where the tax rate exceeds 100%. Nobody pays a tax rate more than 100%. What it tells me is you have two sets of books, your tax books and your reporting books, and the two numbers are very different. So I made a list of all the things that bug me and how much they bug me. And then I created a score. The higher the score, the more complex your company. Then I said, do you like this more? And they said, this is so much better. I said, there's one small cost, a big cost, to using this measure. To get the score for Citigroup, what do I need to do? Read 1,000 pages, right? I said, I don't want to do this, but this semester, each of you is valuing a company, right? They said yes, and they could see the train coming at them down the tracks. Too late to get out of the way now. I said, this semester, in addition to valuing a company, why don't you come up with a complexity score? It wasn't a choice. It wasn't, why don't you? You have to come up with a complexity. They bitched and they moaned, but what choice do they have? They should have just gone with the number of pages that I offered in the previous session. But that semester, in addition to getting a valuation, I think there were 250 people in the class, every person valued the company and also gave me a complexity score. And there's some very interesting things that came through. The first is there was almost no correlation between company size and complexity. I thought bigger companies would be more complex than smaller companies. That wasn't true. Second, emerging market companies are about 20% more complex than developed market companies, usually because of cross holdings and family group structures. Companies that grew through acquisitions are almost 40% to 50% more complex than companies that grew with internal investments. If any of you are valuing companies that do acquisitions, you've discovered this the hard way, right? Because when you grow through acquisitions, you have this goodwill item that shows up on your balance sheet. You don't know what to do with it when you compute return on capital. You have impairments. You have acquisition-related charges. Makes it much messier to do. And any company with a capital arm was almost automatically about 30 to 40% more complex than a company without it. You know what I'm talking about, a capital arm? GM, GMAC, Volkswagen, Volkswagen Capital. And in fact, if any of you are valuing companies where there is that capital arm embedded in the company, it makes the company much messier to deal with because you put a bank in the middle of a regular company. You might have claimed to put Chinese walls around it, but I have no way of knowing. In fact, that semester, out of the 250 companies, the company that came out as most complex was a company I would create if I were the devil and I wanted to torture investment bankers who ended up in hell. The company I'd make them value over and over for the rest of eternity, like Groundhog Day. I mean, think about it. You have a company that grows through acquisitions, is multiple businesses in many countries, special purpose entities. I mean, if you're designing a company to torture people, it'd be GE, right? The old GE, 26 different businesses, every country grows through acquisitions, has GE capital embedded in it. And when times were good, people just overlooked it, right? But when times turned bad, that complexity came back to almost destroy them. So the bottom line is, can you measure complexity? Yes, this is a simplistic measure, number of pages. and these complex measures you can come up with. But the bottom line is, if you decide to bring complexity in the process, you got to pick your poison. You got to show me where it will show up in the valuation. Remember the 8 proposition. If it is going to affect value, it's got to show up either in the cash flows or in the risk. And I'll give you the choices. You can take your complex company and be more conservative when you estimate cash flows. Why? Because you don't know what it does. You can haircut the cash flows. You can you can take your complex company, and remember, one of the sources of value is how much more than the cost of capital you expect this company to earn on its projects. Let's say it's earning well above its cost of capital, but you have no idea how it makes money. You know what you should do, right? Close that gap as quickly as you can, because if you don't know how it makes that excess return, how can you assume that it can keep doing this in the long term? On my plane trip here last night, I couldn't go to sleep. And I was watching the Enron movie, and Netflix has it. Watch the movie, right? Basically, you know the story of Enron. And of course, a lot of villains involved. But I am convinced that in 1999, you'd walked into Enron and you asked them, how much debt do you owe? Nobody there would have known the answer. It created so much complexity, they didn't know. And even more, if you ask me, how does Enron make money? It was a mystery, even in its glory days. They were energy traders. What does that mean? Who are you buying this from? Who are you selling it to? Why are you making a margin? This was a business that was a mystery even in its best days. So even without the benefit of hindsight, I remember people in 97 and 98 picking Enron to value because it was a star company. Coming to say, I don't know what they do. They make a lot of money, but I don't know how they make money. And if you're valuing a company like that, the best thing to do is, since you don't know there's fraud, maybe there is fraud, is to start to be more conservative about the kinds of excess returns they make. Or the final adjustment you can make is you can use a higher discount rate for complex companies. You're saying how much higher? Complexity is one of those loose ends that I spent a month looking at during my sabbatical. And what I did was I took the S&P 500 and I created a fairly arbitrary breakup into simple and complex companies based on the number of businesses and special purpose entities. So 250 simpler companies, 250 more complex companies. Remember how I computed the implied expected return and equity risk premium for the S&P 500? I did that for the two groups separately. I said, what's the implied cost of equity for my simple companies? What's my implied cost of equity for my complex companies? And the difference was about 1.2%. Basically, the market was demanding a cost of equity that was 1.2% higher for complex companies. Don't take that as absolute, because that number goes up and down. During good times, that difference seems to go towards zero. 1999, there was no difference between complex, but during bad times, the difference widens out. During crises, you will see the difference widen out. It'll be interesting if I could track this by day, what the last 4 weeks have done to that difference, because during bad times is when you start to notice complexity. And as a final throwaway, this month I spent on complexity, I ran a regression. I ran a regression of price to book ratios against return on equity, beta, and growth, which are kind of conventional variables. We'll talk about why we always think of those as the fundamentals that drive price to book. And then I threw in the number of pages into this regression. How would you read this coefficient? Minus 0.003. Every 100 additional pages in your 10K lowers your price to book ratio by 0.30. Imagine being Citibank's consultant. He said, price to book is low. What should we do? Knock 300 pages off your 10K. Sounds facetious, but think of why Citigroup ended up with 1,000 pages in its 10K. In 2001, it's deliberate. It was a fact that they went out and bought Travelers, and they became this they branded themselves as, we're going to be all things to everybody. We're going to be a bank, an insurance company, an investment bank, a real estate company. There's a price when companies start to spread and try to be multiple things to multiple people. And one of the prices, they get more difficult to assess. The final point is, pre-2008, we used to think of banks as fairly simple entities. Part of the reason is we thought of banks the traditional way, right? How do banks make money? They borrow money at 4%, they lend it out at 5%, they make money on the spread. And what we missed is in the 2 decades leading into 2008, banks had become more and more complicated. We just didn't see it happen because it was under the surface. They'd become investment banks. They were making money on swaps. They were securitizing things. I'll be quite honest, banks to me remain the biggest mysteries in valuation. So the more I don't know when I value a bank than any other type of company. If you don't believe me, take a bank like JP Morgan. If you gave me a regional bank, I can get away with it because it's more, the more you look at these money center banks, the more you recognize why people are scared. Because there's so much you don't know. Any questions on complexity? So as you look at your company and you get frustrated by the fact that things are messy, keep this in mind that that's something that will show up in the pricing of these companies, because as things get messier, especially during periods of crisis, you're going to see the price drop down. So let's talk about debt. The start of the class, we had that simple experiment. We know what the rule is for debt when you do cost of capital. It's to be narrow in our definition of debt, include all interest-bearing debt and things like lease commitments, contractual commitments. That's how we define debt when we do cost of capital. That's when, but when you talk about the debt you subtract out from firm value to get to value of equity, I would suggest you use a much more expansive definition of debt. Let's start with this market value, book value, and then I'll talk about what I mean by expansive. This notion, and this is a rerun of the start of the class test, is in every traditional valuation textbook, you're told that when you compute the value of equity, you take the value of the firm that you get by discounting cash flows and subtract out the market value of the debt. And I'll give you the intuition. The market value of the debt is based on the presumption that you'll still make your full debt payments, but there's much more risk involved. The only problem, though, is that that discount you see on book value comes entirely from the fact that I think you might default. And if I try to acquire the firm, that'll disappear. And that'll mean that whatever I thought is the value of the equity becomes a mirage. So when I do traditional discounted cash flow valuation, where I assume you're a going concern, I'm going to stick with market value. But the minute that going concern assumption comes under threat, either because of an acquisition or you plan to do a liquidation, then I need to go to book value. So if I did a liquidation value of this company, liquidation value, I look at what I get from selling the assets, I'm not going to subtract out market value of debt from it because I have to pay off the debt today. This is not some present value factor. So when you do liquidation valuation, the book value of debt comes back into play because the bank is not going to settle for 80 cents on the dollar if you have the money to pay the debt. So there you go to book value. And finally, here's what I mean by expats. There are things you worry about as an equity investor that might not show up in traditional debt. I'll give you an example. Valuing a tobacco company in the 90s. Tobacco companies in the 90s were cash machines. They still do make margins of 40, 45, 50%. But in the 1990s, all these tobacco lawsuits were working their way through different courts in the US. There'd be no settlement reached. There was nothing on the balance sheets that reflected expected payments. But if you're valuing a tobacco company, this is hanging over your head, right? You value the company, you subtract out the traditional debt, then you got to ask yourself, what will these lawsuits cost me in terms of expected future cash flows? And some of you might have read the story that Bayer sold off its Monsanto piece just a few weeks ago for like $3 billion. They paid like 20-something billion for the company. But Monsanto, the big problem was when they bought Monsanto, they bought this Roundup liability that came with Monsanto. So if you're valuing Bayer, you'd have to factor that in. I mean, now I don't have to anymore because they've sold it off. But for the last few years when I valued Bayer, I had to value Bayer, subtract out the debt, then say, what would the expected payout be because of the Monsanto lawsuits? You're saying, how the heck am I going to estimate that? Get a good trial lawyer, friend. This is not a finance question. Because in the US, it's actually very messy. You got to estimate the likelihood that you will lose not just the first lawsuit, but the appeals that come from it. Because remember, many tobacco companies would lose $5 billion in that first jury trial. And by the time they got to the final payment, that might be down to $50 million. You'd also have to estimate what the actual payment would be. So if you're thinking about a niche in investing where I think you could potentially make money, it's to band together with a lawyer and actually focus in only on companies that are targeted in lawsuits. Because if you can get a little better than the market in assessing that likelihood of how lawsuits play out, you're going to come out a huge winner from this process. I still remember when Merck was targeted in the Vioxx lawsuits, this is, I think, 2008. For about 4 or 5 years, the only thing that moved Merck's stock price is whatever they happened in the most recent lawsuit, whether they were found to win or lose on that lawsuit. So it's a factor that's going to affect your overall valuation. Any questions on the debt component? Which brings me to the stock-based compensation issue. Somebody on Zoom have a question? Yeah. Let's talk about stock-based compensation. If you go back 40 years, go to 1981, 1982, you look at companies, stock-based compensation was this tiny piece, if at all. If you wanted to reward CEOs, you gave them bonuses, but the bonuses were cash bonuses. In the 1990s in particular, you saw stock-based compensation take off. And you know, one reason for that was Congress's ham-handed attempt to keep executive compensation capped. In 91 and 92, the US Congress passed a law that restricted how much companies could pay their top management in dollar terms. But at that time, nobody thought about options, so they excluded options and other stock-based compensation. So in a sense, they were inviting companies that wanted to pay more than that, just used options instead. So one factor driving the rise of options in the 1990s was this tax law that said, don't pay more than 2 million. I don't know the exact cap, but you can't pay more than that cap. The other, of course, was the growth of this .com sector. You're saying, why does that explain? Because these were young companies with lots of potential and huge market caps, but they're all losing money. In fact, this still continues to be a factor. When you're a money-losing company and you want to attract talent, you can't compete with companies that have the cash to pay 300 because you don't have the cash. So what do? You offer equity compensation instead. I don't know, was Amazon still the largest employer last year at Stern? And I think increasingly Stern MBAs are going to go work with tech companies and young companies, many of which are money losing. Those companies can't compete with the Goldman Sachs and the McKinseys of the world in terms of pure salary because they don't have the cash to do it. The way they will sweeten the pot is if you come here, we'll give you options, we'll give you. So the reason for stock-based compensation is not some convergence of incentives, because that's what you read in textbooks. It's really the fact that many of these companies didn't have the cash to pay compensation, they had to pay in stock-based. And that stock-based compensation can take two forms. In the 90s, it started with options. And we'll talk about why that's a messier way in which you can compensate. And since 2007, it's increasingly become what are called restricted stock. Restricted stock are just shares in the company that you're given. We know what the restriction though is? What are you restricted from doing when you get these shares? You can't sell them for a certain period of time. So basically to make sure you stay around. And if you quit your job before that certain amount of time, then you lose the company. So restricted shares and stock-based compensation. So the questions I want to examine is when you have these options and restricted shares granted, how does it affect your value of the firm and the value of equity per share in this firm? So let's start with the easier problem. As I said, since 2007, I'll talk a little bit about what happened in 2007 that caused the shift. Companies have increasingly shifted away from options to restricted stock units. And if you look at any young company now, whether it's Airbnb or Facebook, when it went public, you'll see dozens of restricted stock offerings to their employees. As I said, the restriction here is on liquidity. And to me, this is the easier problem because if you have restricted shares, I just treat them like regular shares. Now, of course, that might be a little too conservative because you first have to vest. You've got to stay around long enough for the shares to vest. And then there's that restriction that should cause a discount. But to me, those are minor issues. So if all you had were restricted shares, I'm going to take your actual shares outstanding or add all the restricted stock units to the denominator and divide the value of equity by that total number of shares. The problem goes away. And of course, you might underestimate your value per share because you assume the restricted shares trade at roughly the same value as regular shares. But it's easier problem. I'll tell you what makes options difficult. Options are in this limbo between shares and nothing. You see what I mean by limbo? Because until options get exercised, they're not shares. You're saying, won't they always be exercised? Depends on what the exercise price is, right? If the exercise price is much lower than the stock price, odds are they will get exercised, but sometimes people hold them. The exercise price is higher than the stock price, they might not be exercised. You're saying, why would you ever be granted options if the exercise price is higher than the stock price? It might not be at the time you were granted the options. Let's say you went to work for Peloton last year. You know what your option strike price was going to look like, right? At that time, the stock price was like 130 or 150 per share. If you want to work for Peloton, they might have given you options with a strike price of $100 per share. Looks good at the time you got it, but today, those options are not worth nothing, but they're worth very little because the stock price is down to $24 per share. So with the options, the question is, what do I count in? When do I count in? It's always been the impediment to dealing with options. And as long as the only weapon you have is the share count, it's very difficult to figure out what to do with options. There are some people who say, let's count only the in-the-money options. You know the problem with that is? What if your stock price drops? Because a lot of out-of-the-money options, then will become in-the-money options. Your share count is constantly going to change depending on what the stock price is. So what I'd like to talk about is ways in which of dealing with options, starting with the bludgeon approach that used to get used fairly, almost everybody used it until 2005, 2006, where you just adjusted the share count, to what's called the treasury stock approach, which is like this intermediate approach where people try to bring in some of the realities of options, to the third approach where you actually value options, which I think is the right way to deal with options. So to set these three approaches up, I'm going to take a very simplistic example. Let's assume a company with $100 million in free cash flows, a cost of capital of 8%, growing at 3% a year forever. So if you apply the terminal value equation right away, you get a value of $2 trillion. Let's say it's $1 billion in debt, you get a value of equity of $1 billion, divided by 100 million shares, value per share is $10 per share. Now, of course, you decide to give those 10 million options to your CEO with a strike price of $10 per share. Now, part of you is saying, I've given away nothing. The value per share is 10. The exercise price is 10. These options are worth nothing. And that was where we started today's class. Are they really worth nothing? And I said, if you assume they're worth nothing, then you're being unrealistic because those options have time value. So I'll give you the three ways. Let's start with the easiest, the bludgeon approach. In the bludgeon approach, here's what you do. You take the $1 billion you got for the value of equity, and then you divide by the number of diluted shares. What does that mean? You take the actual shares outstanding plus the 10 million shares you gave away in the option, and you come up with the value per share. You know why I call this the bludgeon approach? What are you missing when you do this? There's one very obvious piece. Forget about the time frame. One very obvious thing that happens when these options get exercised that you're missing. What happens when you exercise an option? You pay $10 to get the shares, right? You know what this approach is missing is if these options get exercised, which is what this approach assumes, where does that 10 times 10 million? Because remember, there's 100 million in cash that should be coming into the company. You're completely missing it. So when people use fully diluted earnings per share, fully diluted value per share, what they're missing is that there's an exercise proceeds from the options that are slipping through the cracks. So the second approach fixes that problem. Here's what it does. It takes the value of equity. It adds 100 million you're going to get when the options get exercised. So based on the presumption that you're going to exercise them, it adds it to the numerator, then divides by the 110. And in this approach, you get the accounting view of the world, which is if you grant options that are at the money, nothing happens. So in the treasury stock approach, you're effectively ignoring the time premium on the options. So the bludgeon approach, you're going to underestimate the value of equity because in the treasury stock approach, you're going to overestimate the value of equity because you're ignoring the time premium of the options. There's a Goldilocks solution here, right? The Goldilocks solution is to take the options and value them as options. What does that mean? When you grant employee options, you tell me the maturity of the option tells you how many years are left. So if you look at the footnotes, to any company's financials, they're required now to reveal what the average maturity of the options is. You also tell me what the average exercise price is. If you tell me the average exercise price and the maturity of the options, I should be able to value the options using an option pricing model. I have a stock price, a strike price, a maturity. Of course, I need a variance for the stock, but that is independent of options being granted. I can value the options. And then what do? I subtract the value of the options from the value of equity. Why? Because there are two claim holders now in the company. One is you and I as common stockholders. The other is the option holders. I'm removing their claim. And once I've done that, I divide by the actual number of shares outstanding, not the diluted number, because that would be double counting. I divide by the actual number. There's one caveat I need to add there. Option pricing models were designed to value listed options on the CBOE, the Chicago Board of Options. You think, so what? Those listed options tend to be short-term, right? 2-3 months, not 10 years. They tend to be third-party exercises. There are no additional shares created when you go out and exercise an option to CBOE. And almost always those options get held through expiration. Why? Because if you want to cash out on an option before expiration, it's almost always better for you to sell the option than to exercise it, because the price will be higher than what you get as exercise value. So option pricing models tend to work really well if I'm valuing a 3-month option in the CBOE, because every requirement gets met. But think about employee options. First, they're not 3 months, they're often 5 years or 10 years. They're much more long-term. Second, when an option gets exercised, and it's an employee option, the company can actually issue new shares. So actually there can be a dilution that happens at the time of exercise. It's true, companies can go out and buy shares and use it, but they can issue new shares, which means there's a dilution effect that can affect your value per share. And third, if you're an employee, let's say you're an employee at Zoom, you imagine how much your options would have been worth in the middle, at the start of 2021, in the middle of 2021, stock was trading at 400. Let's say you knew in a moment of honesty that this could not last. You could look at the inside of the company. There's nowhere we're worth $400 per share. You're saying, why don't you just sell the option? Employee options cannot be sold. They're not liquid. You see where I'm going? With employee options, you're going to get early exercise far more frequently, because you don't have the choice of selling the option. If the stock price rises enough and you get scared about it staying up, you're going to exercise your option earlier, which means when I use an option pricing model and I take the stated maturity of 5 years or 10 years, I'm overvaluing the option because the option might get exercised in 2 or 3. In fact, studies consistently show that employee options are exercised about halfway through their maturity. So when the company says there's 10 years left in the option, often they'll get exercised by year 5. But those are fixable problems. And here's what I'm going to do. I'm going to argue that I can take the traditional option pricing model and adapt it. Adapt it by doing what? There's a way in which you can adjust. The traditional option pricing model, the stock price is a given. It's not changed by you exercising the option, because it's assumed you don't issue shares. But the version of the model that I'm going to use, I'm actually going to adjust the stock price for exercise, which basically means if you exercise, you dilute the shares, the share price will go down. Second, instead of using the actual life of the option, I can use half the life, saying, you know what, it's a 10-year option, but typically they get exercised in 5 years. Both of those adjustments will lower the value of the option, but I'll still get a value for the option. So I know people claim, and these are purists. They say, well, it's not, you can't value a long-term employee option. That's not true. In fact, for the last 14 years, accountants have had to use option pricing models to value options. And if accountants can do it, we should be all able to do it. You know why accountants have had to do it? I'll tell you the story of what happened in 2007. 2007, finally, accounting came to its senses. It said, look, if you grant an option as employee compensation, rather than treat it as worth nothing because the stock price is equal to the strike price, we will value these options and subtract it from your revenues as expense that year, which is actually the right thing to do, because you are giving this as employee compensation. Like any other compensation expense, you should be treating it as an operating expense. That happened in 2007. The minute that happened, guess what companies started to do? They started to shift away from options because the free game was over. Because until then, they could give options. Nobody knew how much of the company they were giving away till 5 years later or 10 years later. When you woke up to the fact that these options are being exercised and your share count was suddenly magically 20% higher, 25% higher. So in the case of this particular example, here's what I did. I took the stock price of 10, strike price of 10, but then I adjusted for the fact that if you, I mean, here's the game I played. I said, if you go out and exercise all these options today, what will happen to the stock price? And when I did that, the price that I got from the dilution was $9.58. So I'm replacing the actual price with this diluted price that captures the dilution effect. And if I'd wanted to, I could have reduced the 10 to 5. I didn't in this case. But the value that I got with an option pricing model was $5.42 per option. So let's see what you've done. You've given away 10 million options, each of which is worth $5.42. If I value the 10 million options, that gives me a value of 54.2 million for the options. I subtract that 54.2 million from the $1 billion that I got for the equity. I've removed the option overhang, and I get a value per share of $9.46. Essentially, by valuing the options, I can take into account not just in the money options, but out of the money options as well. Because just because they're out of the money doesn't mean they're worth nothing. But it's true that as the stock price drops, the option overhang will get to be less onerous in the company. When I valued Peloton 2 years ago, I valued Peloton now. At its peak, the overhang on Peloton was huge. Now it's become smaller because the stock price is lower. So when you look at options, this allows you to capture options outstanding, reflects the likelihood that these options get exercised and how much of a value drag they're going to be on your shares. So let's summarize. A lot of people, when they look at options, take the easy way out. They just adjust the share count by counting all options. The treasury stock approach is kind of an intermediate approach, but they're ignoring the time value of money in these options. The full way to bring in options is to value the option, which is one reason in my Ginzu spreadsheet, I have that option worksheet, which automatically feeds in from your valuation and feeds back as a cost. But because there's circularity, do you see where the circularity is? Your value per share is going to be a function of your options, and your value of the options is driven by your value per share. So the reason I make you check that iteration box in Excel is if you didn't do that, the process breaks down. So if any of you have trouble with that option worksheet, it's probably because you forgot to check the iteration box in Excel, because without it, the whole process will in fact break down. A couple of final notes on options. It's true that because options are treated as expenses, they give you a tax saving. So if you value options at 54.2 million, there are some people who multiply by 1 minus the tax rate to come up with the value of the option, saying when you give these options or you allow the exercise of the options, you will get a tax advantage. You can do it, but many of these companies that grant options are often money-losing companies. So it's a little dangerous to be taking a tax advantage you might not be able to get when these options get exercised. So if you skip it, I think there's a good basis for skipping and just taking the entire value that you get for the options. Yeah. And finally, all of this takes care of options you've already granted. But remember, you're not done. You might continue to grant options in the future. You say, what do I do about those? Some people try to adjust share count in future years for option issues. Don't even go there. It's just too deadly, too dangerous. If you think options are going to be granted in the future, just treat it as an expense item. It reduces your earnings, reduces your cash flows, and don't fall into the analyst trap. And many companies also go into this trap of saying stock-based compensation is not a cash expense. So let me add that back. That's absolute nonsense, because all you've done is skipped a step. If you've taken those options, issued them to the market, taken the cash and paid your employees to be treated as an expense, why should I let you evade that? Just because you did this, you skipped that step. So you'll see many companies, you take a look at many of the companies that have gone public over the last decade, they'll have an adjusted EBITDA, where they would start with their existing EBITDA, add back stock-based compensation. That's almost negligence in valuation when you do that. That makes no sense. Don't fall into that trap, because just because you use an in-kind way of paying for expenses doesn't mean it's not an expense. Any questions on stock-based compensation? So let's look at where, if you have options, it is going to affect your value the most. Options are going to affect your value the most when your strike price is low relative to the stock price. Second, when there's a long life to maturity. So 10-year option is worth more than a 5-year option. And it's worth more when there's more volatility in the stock. Now, do you see why tech companies, options are such a big deal? Right? They tend to be companies with stock prices risen a lot. So the stock price is higher than strike price. You have 10 years to maturity. These are very risky, very volatile stocks. The option value, the option drag can be 15, 20, 25% of value. Later in this class, I'm going to show you a valuation I did of Amazon in January 2001. I valued Amazon at about $15 billion, but the option overhang was almost $3 billion. 20% of the company had been given away in the previous few years because the company had been so easy with granting options. I mean, that's the price you pay when you treat options incorrectly, is it becomes free currency. Any questions? So now I want to circle back to something I started in the first class, but I think is one of the things I'm going to be looking at when you send your valuation to me. You're going to be sending me a spreadsheet of growth and margins and cost of capital. But what I'm looking for is the story that binds those numbers together. And I want to talk a little bit in the rest of this class about what I mean about that story binding numbers together. You remember at the start of the class, I said, if all you have are numbers in a spreadsheet, you don't have a valuation, you have a financial model. I'm going to complete that story. If all you have is a big story, it's not a valuation, it's just a big story. I've been watching We Crashed. You can say I watch a lot of TV. I've been watching We Crashed for if you on Apple TV, it's a WeWork fiasco played out as a movie. Well, watch it. I mean, it's a great example of what happens when you have storytelling without bounds. You have fairy tales. So good valuation is not just a story. It's not just numbers. It's connecting the stories to numbers. It's a bridge between stories and numbers. Because left to our own device, and I said this early on, we wallow in our weaknesses, right? If you're a number cruncher, you think by adding more decimals, you got a more precise valuation. If you're a storyteller, you just make a story bigger and bigger and bigger because it gives you a higher price. So I'm going to take you through a 5-step process that I follow in trying to value a company. And it's a process that works for me. So if you can make it 3 steps, 11 steps, find a process that works for you. And I'll talk about why I have to go through this 5-step process. It's because I'm a natural number cruncher. I have to force myself through this process because it forces me to think about the story. So what I'm going to do is I'm going to go through the 5-step process and use an example to illustrate how this process plays out. It's an example that you're all familiar with. It's a valuation I did of Uber in June of 2014. Very early in its lifetime. The value is hopelessly outdated. I mean, you can get my updated value of Uber if you go to my blog. But I'm going to go through the process. You can see the process play out. So the first step when you sit down to value a company is you need to tell a story about the company. That's the first step. So don't open the Excel spreadsheet. So you can look at the numbers from the past, but you're trying to frame a story. Okay? So in coming up with the story, obviously you need to understand what your company does, what it sells, who it sells to, what the market looks like. So I'm not saying you just start the story with a blank slate. You do your research in terms of collecting this information so you can frame your story for the company. So take you back to June of 2014. June of 2014, I opened up the Wall Street Journal, and it was actually a physical copy then. I wasn't reading the online edition. And I see a news story about a company called Uber that had raised, I think, $3 billion from venture capitalists who had priced the company at $17 billion. And I make a confession. I'd never heard of Uber in June of 2014. You say, what rock did you live under? I mean, I lived in New York. I took the subway where I went. I never took cabs. I never took car service. Let me take that back. I said I'd never heard of Uber. That wasn't true. In the 2 months leading into June of 2014, in my credit card statements, I was seeing the word Uber. Because it turned out that my second son was going to college in North Carolina, was using Uber and using my credit card to back it up. Don't ask me how that happened. I thought he was taking German language classes, to be quite honest. I had no idea what this Uber thing was. But then I saw the 17 billion, and no German language class could be 17 billion. So my first line of research was to call him. You're saying, why do you open up the financial statements? What financial statements? In June of 2014, Uber was a private company that was incredibly secretive. The only things I could find out about them were the gross billings they had in the previous year and how much money they lost. And that came out of a leaked presentation they'd made to some venture capitalists. So there wasn't a question of why don't you just download the data from S&P Capital IQ and look at it, because there wasn't much to look at. So I called my son and he doesn't pick up the phone. It's 11:30 in the morning. Turns out that he was sleeping in. He kept college student hours. Remember those? You go to bed whenever you feel like going. It's got nothing to do with the sun and the moon and all the rest of the stuff. It's whatever time zone you're in. So I called my niece, who was living and working in Chicago. And she actually had to be at a desk because she was working. She was technically awake, but in a foul mood. She picks up the phone and says, what do you want? This is how she greets a favorite uncle. And I said, have you heard of this company called Uber? She said, it's a ride-sharing company. And I said, what's a ride-sharing company? She said, I don't have the time to talk to you now. Why don't you just download the app and find out for yourself? Hangs up the phone. She talked to her mother about this behavior, but I downloaded the app. Actually, it was up in my office. Download the app, hit the app. Magical things start to happen on my phone. I see a GPS opening up and I see a car trying to drive towards me. I watch this guy and I can see the name of the guy too. It never happened to me with the yellow cap. 20 minutes later, he pulls up in front of this building and I run out and say, hi, George. He says, where do you want to go? You didn't enter a destination. I said, nowhere in particular. Could you drive me around for about 30 minutes? I have some questions to ask you. Briefly, he thought I was a serial killer, but then you know what, I can take this guy, get in the back seat. So I got in the back seat and started asking him questions. I said, is this an Uber car? He said, no, this is my car. I said, are you an Uber employee? He said, no, I'm an independent contractor. I said, why do you do this? He said, I have a regular job. I don't make enough money at it. I already own this car and I pay insurance on it. This allows me to earn a second income on the car. I said, why do you need Uber? He said, in New York City, it's illegal to stop on the street and offer a ride. Uber connects me with customers. This stage, I'm getting a semblance of why this guy uses Uber. It allows him to connect with customers with a car that he already owns and earn a second income. 30 minutes later, he drops me off. I offer to pay him. He should have just taken the money. He said, you don't have to pay me. I said, it's free? He said, no, it's not free. When you downloaded the app, they asked for your credit card. I said, yes. So they'll charge you. I said, that's interesting. How do you get paid? He said, they'll send me 80% of the fare. I still remember asking, why 80%? He said, I don't know. That's what they all do. And he drives off. At this stage, I could see why Uber did what they did. By connecting cars to customers, they got to keep 20%. This is a sweet business to be in. You don't own the cars. You don't hire the drivers. You keep 20% off the top. Which left me with one final question. Why do people like my son and my niece like Uber? So I called my son, this time at what I thought was a civilized hour, where he couldn't be sleeping anymore. It's like 3 p.m. and he was finally awake. And I said, I noticed you, I decided to put him on the defensive, good way to extract more information. I said, I noticed you've been using my credit card to back up your ride sharing. I had no idea what ride sharing was when the credit card payment came through. I said, why would you need to use a ride sharing company when you own a car and you keep it in North Carolina? He did own a car that he kept. And he said, Dad, on Friday nights and Saturday nights, I really like Uber. Now, as a parent, you let some things go because you can read the subtext. I said, that's interesting, because this is a kid. I can't even imagine him calling or hailing a traditional yellow cab. That's not even in his frame of reference. I said, what do you like about Uber? He said, I can call the car from the bar. I said, that's good. I said, you must wait forever, right? He said, no, they come faster than a cab. I said, you must pay a lot, right? He said, no, they're cheaper than a cab. I said, cars must be filthy, right? He said, they're cleaner than a cab. I said, let me get this straight. They come sooner than a cab. They're cheaper than a cab. And they're cleaner than a cab. At that time, I knew ride sharing was going to, the cabs was destined for doom. There's no way you can compete against a service that's cheaper and cleaner and faster. Which left me with a final question of what's so special about Uber? Why couldn't I go down into my basement, buy an expensive computer and connect cars to customers? And I could think of two things that Uber had that I did not. One was $3 billion. They had it, I didn't. It's a little bit of a disadvantage. The second was, this is a business where there's networking benefits. You know what I mean? As you get bigger as a company, it actually gets easier to get bigger, because if you're a driver and you want to drive for a ride sharing company, and I give you two choices. Do you want to drive for Uber? Do you want to drive for the startup? You're going to go with Uber simply because that's where the customers are. It's a business that as you get bigger, it actually gets easier to acquire both riders and customers, because you get that size starts to attract. So when I was done, here's what I did. I drew a picture of what I'd learned. I try to do this anytime I try to value company, is when I learn about things, I try to draw a picture of what I've learned about the company. How does it make money? Why do people like it? What are the pluses and minuses? In the case of Uber, I could see it's a ride sharing company. I could see that it owned the cars. I could see its competitive advantage as a first mover. They had a significant market share of this business, which is going to give them an advantage going forward. What I'm trying to say is, especially in the last 20 or 25 years, research has become downloading numbers from Capital IQ or FactSet and computing every conceivable ratio known to man. But learning more about a company sometimes means talking to people. I've learned more about Uber by talking to Uber drivers. I think they hate me around the world because I get an Uber and I start asking questions. Who's the competitor here? What does Uber pay? Do they treat you nicely? They think I'm being humane. And maybe I am in some indirect way, but I'm extracting information because this then becomes part of my Uber story and Uber valuation. You will learn more by talking to Uber drivers than you will by talking to Uber management. I've found this, I've never valued a company talking to top management. I find it's the biggest waste of time. These guys are politicians, they do the PR stuff. They're not going to get it. I mean, you're better off going down to the basement, talking to the mailroom clerk and finding out, is anybody at their desk at this company? Do half the people show up drunk? And then you go back and write a story about the company. It's probably going to be closer to the truth than what you get by talking to the CEO or the investment relations officer. So that was my research, the starting process on learning more about the company. Here's my second step. I've learned about the company. I need to tell a story. And I want to caution you here. This is a business story, not a creative novel. Don't introduce characters for no reason at all. I'll tell you what you shouldn't be doing if you're telling a business story. About 15 years ago, my oldest son came to me with a reading suggestion. He said, Dad, you got to read this book. It's an amazing book. He hands me the book. I almost fall over. It's like 1,200 pages thick. Look at the front of the book. It says Game of Thrones, George R.R. Martin. And I'll tell you, I tried. But 600 pages in, I called my son and said, Ryan, I'm too old for this. There are hundreds of characters in this book. They wander in, they wander out, they die, they come back to life. They're good guys, they're bad guys. I can't keep track of them. If you're telling a business story, don't make it Game of Thrones. You don't have 8 seasons and 80 episodes to tell your story of like 15 minutes. Business stories need to be focused and they need to be simple. The simple part means you don't introduce extraneous characters. The focus is ultimately every business, what's the end game? You need to make money. You need to show me that you've thought about that possibility. I know that if you're a young company, you will not make money next year, but you need to tell me how you think. If you notice in Shark Tank, sometimes people get on, they talk about the exciting product, and then one of the sharks says, well, how do you plan to make money? And the person says, I haven't thought about that, but let me tell you how exciting this product is. That person's not getting much money from sharks. Keep it simple, keep it focused. So I took my own advice. And here's the story I told about Uber in June of 2014. I want to keep emphasizing the day, because my story for Uber has obviously changed over time. But my original story, I described Uber as an urban car service company. You see, with my story, I'm already telling you where I see Uber succeeding as a car service company in cities and big towns, which will expand the business by bringing new users in. People like my son and my niece, who otherwise would not have been in the car service business, are going to come in because of the way they've structured the business, with local networking benefits. You think, what's a local doing there? I told you what networking benefits are, right? As you get bigger, it gets easier to get bigger rather than having to fight. And usually as businesses get bigger, it gets more difficult. But networking businesses, it gets easier to get bigger. You're saying, what's a local there? In my story, Uber can end up dominating New York. Lyft can take Chicago. Didi can take Beijing. Grab can take Kuala Lumpur. So in my story, individual cities will have networking benefits, but different players can win in different cities. Why does this matter? The kind of market share I can give Uber is going to be driven by whether they have local networking benefits or global networking benefits. Companies like Google and Facebook have global networking benefits, which means as they get bigger, there's really no reason for it to be localized. It's online advertising. And then I did assume in 2014 that they could keep doing what they were doing then, which is what? Not own the cars and not hire the drivers. It affects the business model, right? You don't pay Social Security, you don't pay any of the things you have with normal employees, you don't have to buy, the healthcare can be patchwork. But that's what they were doing in 2014. That was my base story. Third stop, I've got to stop and make sure that I'm not deluding myself. Remember, when you value companies, the person you're most likely to delude is yourself. Because if you really love the company, you can find a way to justify the valuation. Third step is really about keeping yourself honest. And you got to pass your story through what I call the 3P test. Is it possible? Is it plausible? Is it probable? Sounds like I'm playing on words, right? But let me give you an example to illustrate the difference between possible, plausible, and probable. Came to me about 5 years ago. I was doing this narrative and numbers across 3 cities in Latin America on 3 separate nights. So night 1 was in Sao Paulo, Brazil. Night 2, I was in Santiago, Chile. Night 3, I was in Lima, Peru. So first night I stopped in Santiago, 300 Brazilians in a room. And I'm trying to think of, is there some way I can explain the difference between possible, plausible, and probable that everybody in this room will relate to? So you have 300 Brazilians in a room. What's the one topic you could pick where every person in that room is going to have a point of view? Soccer. This was 6 months before the 2018 World Cup. I started with the question, is it possible that Brazil will win the World Cup? You ask 300 Brazilians 6 months before a World Cup, is it possible that Brazil will win the World Cup? What kind of answer do you think you're going to get? Of course, we've done it 5 times before. I said, okay. I said, is it plausible that Brazil will win the World Cup? A little bit of, hemming and hawing, but I'll tell you, if I'd asked this question in December of 2014 in Brazil, the audience would have been a little shaky. You know what happened in 2014? There was another World Cup, and Brazil is actually the host of the World Cup in the semifinals. And this is one of those incidents that's etched into Brazilian memories for the rest of eternity. They played Germany, and I think they lost, 8-2. It's one of the great shellackings of all time. My point is, in December of 2014, I said, is it plausible that, no, I don't know, this team doesn't look good. But by 2017, they were actually feeling pretty good about, about their team again. They were second ranked in the world. They said, yeah, it's plausible. Then I said, is it probable that Brazil will win the World Cup? And now you could see the wheels start to turn. If you put in the right group, if Neymar stays healthy and he doesn't flip and flop and do whatever Neymar does, yes. With each one, you can see I'm upping the ante. To me, this is the key in valuation, is when I tell a story, first I have to make sure it's not a fairy tale, that it's not impossible. You want to rule that out. Second, you want to ask the questions to see, is it plausible? Has somebody done something like this before? Can you show me some evidence that this has worked somewhere? And then I want to dig a little deeper. What are the unit economics? What does it cost you? Because I want to go from possible to plausible to probable. To me, this is what separates great VCs from average VCs. VCs couldn't value a $20 bill in a brown paper. It's not valuation that separates great from good VCs or bad VCs. Great VCs are able to ask the questions that go from, that take stories and allow them to separate the probable stories from the fairy tales. So I'll give you examples of impossible stories, implausible stories, and improbable stories. Here are some examples of impossible stories. I tell you about a company that's going to keep growing. So far, so good, right? grow 6% a year forever. Even now you can say, okay, maybe in Argentine pesos. But if it's 6% a year forever in US dollars, I've created a fairy tale. Why a company that grows at 6%, no matter how upbeat I'm about the company, if I let the company grow at 6% a year forever, it's going to hit a cap. And then what? You know what fairness opinions are? They're fig leaves that bankers offer acquirers. So if they get sued afterwards, they say, look, I got a fairness opinion from a banker. So when I see fairness opinions, I cut bankers a lot of slack. I know that they're not exactly staying true to the first principles of valuation. They have another agenda. But in 2015, remember when Tesla bought Solar City in one of the most hopelessly conflicted deals of all time? So in this deal, what made it conflicted? Who's the largest shareholder in Tesla? A guy called Elon Musk. Who was the largest shareholder in Solar City when they bought it? A guy called Elon Musk. What a coincidence. It's the same guy. Who's the CEO of Tesla? Elon Musk. The CEO of Solar City was his cousin. So when Tesla bought Solar City, they knew they were open to all kinds of lawsuits. So they decided to buy protection. By doing what? By hiring 2 investment banks to come in and give fairness opinions, because the Delaware courts, in a moment of incredible stupidity in the 1980s, actually created the shield that if you created fairness opinions from banks, you could effectively be protected against lawsuits. So Solar City goes out and hires Lazard, and Tesla hires a company, local boutique investment bank called Evercore. You might have heard about them, pretty highly regarded. What's a boutique investment bank? It's like a gastropub at an airport. Have you ever been by a gastropub? It's basically a gastropub is you basically get Burger King at 3 times the price. But you call it a gastropub. So boutique investment banks do what investment banks do, but they charge 3 times the price. So both investment banks go to work. And because this is an exchange offer, they had to value both Tesla and Solar City to show that the ratio was right. So I'm looking, and what they do actually becomes public information. So a few months later, I'm looking through what Lazard and Evercore are doing, and I leaf through the Evercore valuation of Tesla. And I get to the assumptions they've made, and they've told stories about Tesla growing over. And so the stories by themselves are all plausible, right? You 30% growth and I have 10% growth. That's a different story. They get to the terminal value and they assume that Tesla will grow at 6% a year forever. My first reaction is maybe they're working in a different currency, but it was in US dollars. That's an impossible valuation. No matter what you think about Elon Musk and Tesla, there is no way a company can grow at 6% a year forever if the risk-free rate is 2% to 2.5%, the economy is growing at 3%. Impossible valuation. Here's a second example. It's actually from this class 15 years, not that long, of course, maybe 6 or 7 years ago. Somebody picked Netflix to value. Netflix is a fun company to value, exciting company to value. A hamster wheel in my view, but it's still a very exciting hamster wheel. So, it was mid-semester, just like this semester. I offer this one time, I'll give you feedback. So I get a bunch of valuation, including the Netflix valuation. This guy's Netflix valuation comes in. He's come up with a value 5 times higher than the stock price. And I'm puzzled because at that time, at any time, coming up with a value that is higher than the stock price is tough enough, but to get 5 times higher, so I take a look at his numbers. And his projected revenues of $600 billion by year 10. So I emailed him and I said, can you come in and talk to me? I have some questions about valuation. So he comes in and I said, do you have Netflix? He said, yes. And I said, how much do you pay per year? He said, about $100 a year. Netflix was a lot cheaper then. I said, okay, that's interesting. You pay $100 a year, you've got $600 billion in revenues. How many subscribers would Netflix need to have to get to 600 billion? Pulled out his calculator and said, you don't need a damn calculator. 600 billion, 100, you got 6 billion subscribers. And I still remember what he said. I said, I don't see where this questioning is going. I said, just hang in there. I have just a couple more questions, then you can leave. So what's the population of the world? He said, I don't know, I have to go check, You don't need to check, it's about 7.5 billion. I said, is there something, I don't know, maybe there's a law that's been passed that says every man, woman, child, and perhaps pet on the face of the earth has to have Netflix. He said, don't be absurd. I said, I'm not the one assuming 600 billion in revenues. He said, all I did was take last year's numbers and project them out. I said, what? He said, I took last year's growth rate and just used that as a growth rate for the next 10 years. The magic of compounding can create fairy tales. One piece of advice I would have for you is check your revenues in year 10. And ask yourself, is this even possible? Is this even likely? Because it's easy to lose track of what's happening to revenues when you just put in a 25% growth rate for the next 10 years. So that's impossible. Tesla, 6% growth, Netflix, 600 billion in revenues. Let's move to implausible. Implausible is a story that can happen, but you better have a really good backing for it. I'll give you an example. I valued a company called Almarai. Almarai is the Saudi food processing / dairy company. First time I'd ever valued the company. And one thing that jumped out at me was the margins at Almarai were about 15%. The typical Middle Eastern food processing company had margins of 6%. Now, this isn't a consumer product company. Milk is milk. You can't just brand it and charge a lot more. So I was presenting this in, I think, Dubai. And I said, I don't know, how does Almarai keep all the competition out? Because it's got 15% margins and others are making 6%. Why aren't they in the Saudi market competing against Almarai? And somebody in the audience said, have you checked who the top 15 shareholders in Almarai? I said, I haven't, but I will. So I went to the Bloomberg terminal, typed out HDS. I got the top 17 shareholders in Almarai. Top of the list was somebody bin Saud, part of the Saudi royal family. There's a competitive advantage right there. Member of the royal family standing at the border saying, you can't come in, this is my. No. If you can give me a good reason, then I will step back. But when you tell an implausible story, my reaction is, tell me why. Because it's entirely possible you found a special company, but you need a story then to explain why your company. So if you're telling a story about your company's margins being 3 times higher than the industry average, I can live with that if you can tell me why this company can pull it off. Impossible, implausible, improbable. I'm going to give away the game as to what I'm going to do when you send in your Excel spreadsheets. Because remember, I said, I don't know what the right answer is, but I'm checking for internal inconsistencies. The first thing I'm going to check is your assumptions about growth. So I can see your revenues, are you growing at 5%, 10%, 50? So let's take the possibilities. You have really high growth, average growth, low growth. I'm not going to tell you right or wrong. It's your story. Then I'm going to check your reinvestment. The way I'm going to check it is I'm going to take the difference between your after-tax operating income and your free cash flow to the firm. You can have 15 line items, but when you're reinvesting money, your free cash flow is going to be much lower than your after-tax operating income. And on that reinvestment, you can have high reinvestment, average reinvestment, or low reinvestment. If you had high growth, what should I expect to see in the reinvestment? I should expect to see high reinvestment. And I check your cost of capital. Remember, the median cost of capital in dollar terms for a global company last year was 6.3%. If you had high growth and high reinvestment, I would expect to see a cost of capital a little above or a lot above that 6.3%. You see where I'm going? If you have high growth, I expect to see high reinvestment, high cost of capital. If you have low growth, I expect to see low reinvestment, low cost of capital. So if you, in your valuation, have assumed a 40% growth rate for the next 10 years, you're reinvesting very little and your cost of capital is lower than 6.3%, I'm going to push back. I'm not going to say you're wrong. Maybe there's something about this company that allows you to do this, but I want to know what the story is. I'm checking to see what your story is that explains that inconsistency. I'll give you an example of what kind of story could explain inconsistency like that. 2 years ago, somebody was valuing a toll road company in Asia. You know how toll road companies work, right? You build the toll roads, you open them up, you make revenues from charging people tolls. And he had a 30% growth rate for the next 10 years, very little reinvestment and a low cost of capital. And I said, and he hadn't given me a story. He said, what's your story? And he told me a story that was completely plausible. He said, this company has spent the last 15 years building the toll roads. They just started opening the toll roads. So the growth is coming from the fact that they just started with the toll roads opening up. the reinvestment is done. The infrastructure has already been invested in. So the reinvestment is low looking forward because all you have to do is maintain the toll roads. And many of these toll roads are the only roads connecting airports to cities or between two cities. They become almost monopolies. Therefore, it's low risk. With implausible or improbable stories, what I'm looking for, impossible, implausible story, I'm looking for something that connects those numbers, explains to me. So this isn't something that I need to do. You can actually check your own story, right? What's my growth rate? What's my reinvestment? What's my cost of capital? Think about inconsistencies there and ask yourself, how do I explain? So let's pause, and when we come back, we'll apply this and talk about other kinds of stories and when you might want to push back.